My name's Sam Furman. I work on the Indiana Public Retirement System investments team as a public markets analyst. I will be talking about investing terms you should know. If I leave you with anything, I hope it's the knowledge that this is not an easy topic. Anyone that says it's easy is lying to you, so you should feel comfortable asking questions. I'll give a brief introduction just about retirement planning, what an individual retirement account is. After that, I'll talk about what you might find in that individual retirement account and finish it up with a couple concepts that I think are beneficial as you navigate the wonderful world of investing. Quick order of business with my position on the Indiana Public Retirement Systems investments team. I am not a registered investment advisor, so as such I cannot give personal investment advice, but please don't let that discourage you from asking questions. I certainly can explain concepts and talk through different ideas as it relates to investing. Any securities or positions discussed do not reflect the thought process, or we're not endorsing any particular investment. They're for informational purposes only. So with that, if you had attended or plan on attending future sessions, you'll hear the concept of the three-legged stool, or how we think about retirement. So that first leg is the Social Security benefit payment that you will receive. Each month, each paycheck you pay into Social Security, upon retirement, you receive payments out. So that's the basic idea of Social Security, and that accounts for 1/3 of your retirement security. The next leg of that stool is your employer provided. So as public employees, this is either your PERF hybrid plan or your My Choice savings plan. That's what I work on in my line of work. Hoosier Start, I would also group in here. This is a 457 plan, but it is also something that your employer provides to you. If you've worked in the private sector, you may have heard of a 401k. This is, again, similar to a 457 or your Hoosier Start. They'll be presenting either already have or will be presenting later. But again, this is provided by your employer. So what I will be discussing are investment concepts, particularly as it relates to this third leg, which is your individual savings. One of the most common vehicles is what is known as an individual retirement account, or an IRA. So this is an account specifically designed to encourage retirement savings. When you go to set this up, you'll be given a choice between a traditional plan or a Roth plan. The main differences here are the difference in how these two plans are taxed. So when you contribute to a traditional IRA, that money goes in pre-tax and serves as a tax benefit in the current period. So you'll notice that your tax liability is lower this year because you can deduct it off of your current taxes. Roth IRA, on the other hand, when you contribute to this comes post-tax, so you will not see any tax benefits or gains from contributing to a Roth plan. With a traditional IRA, this money grows what's called tax deferred. So upon retirement, when you start withdrawing money from this account, this money that you withdraw will be taxed as regular income. Whereas as a Roth, since it went in as post-tax dollars, it grows tax-free, and it will not be taxed when you begin withdrawing. So that's briefly the key differences between these two accounts. You can contribute up to $5,500 to each type of account annually. Now we'll talk about some of the things that you might find in these plans. This is by no means inclusive of everything that you can invest in, but just a few of the most common items. So the first one is stock. So stock ownership represents partial ownership in a corporation. So when you're buying a stock, you are buying the expected future profitability of that company. You are a part owner. Stocks will sometimes pay dividends. This is a cash payment directly into your account. So the return on that stock is based on how much the market thinks that that company can generate in profits over time, as well as that cash payment if they choose to pay one to your account. You may also hear public equity or common stock. If you hear those terms, they're talking about stock. You're a shareholder in a corporation. So here on this slide, got an example. Hometown Corporation, Eli Lilly and Company, pharmaceutical company based here in Indianapolis. So this is a stock chart from April 13th to April 2013 to December of 2017. The key point here, if you see stock charts on the news or in the paper, if it's going up and to the right, like in that left half of the chart, you're making money. You've bought it at a lower price. It is now worth more than you bought it. In that center with the red arrow, you're losing money. If it's going down and to the right, the value at which you've bought it is now it's worth less. And then again on the far right-hand side, you're back in the green. And then all along the way, this company's paying a dividend. So quarterly, this company will put a cash payment into your account. So those two components make up your return on the stock. Next concept we'll talk about, or next type of investment, is a bond. So this is an agreement between a borrower and lenders. So in this sense, you would be the lender to a corporation, government, in which the borrower agrees to borrow a fixed amount for a fixed period of time at a fixed rate of interest. So the key terminology here is this maturity. So this is the length of time before the bond, the principal amount is due. The principal amount is the amount at which they borrowed. And then the interest is what they are paying you to borrow that, also called the coupon rate. So if you hear bond, it's also known as fixed income, debt, or loans. Very similar to a mortgage, only in that case, you guys are the borrower. So we'll walk through a very basic example. So in this instance, Company A borrows $1,000 for 1 year at an interest rate of 5% annually. So here, the maturity is 1 year, your principal amount is $1,000, and the interest rate is 5% annually. So in this instance, you guys are the investors lending to this company. This takes place today. You will give them $1,000. Generally, especially in the United States, corporations pay their interest semi-annually. So that interest rate is divided by 2 and paid out 6 months from now. So in 6 months, you'll receive half of that interest payment at $25. And then upon maturity, after a year, you'll receive your other half of your interest as well as the original $1,000 that you lent the company. So that's basic how a very simple, what is called a plain vanilla bond works. Maturity length can vary from anywhere overnight to up 100 years. So there's a wide variation in how long you're lending money for. Quickly go over some differences. So ownership of stock represents partial ownership in that corporation. This is not the case with the bond. You are agreeing to receive interest rate above your amount that you lent, and that's it. Stocks usually contain more risk than bonds, but with that additional risk, it has the higher potential for future growth. And then bonds usually provide more current income than stocks, and this is in the form of that coupon payment or interest payment. Stocks sometimes will pay a dividend. This is a cash payment, but that's not promised, and it's not a legal obligation like a bond is. The last concept I want to touch on and what might be in that IRA is this idea of a fund. So this is an investment pool of different stocks, bonds, or a combination of both stocks and bonds. So when this is one investment into a pool of multiple stocks, for example. So a fund, very simply, could be a fund between Eli Lilly and Apple. And you make one investment, that fund holds both those stocks, you've made an investment, and then the return on that fund is determined on the return of those underlying stocks. So the key point I'd like to make here is this idea of diversification. So when you're investing into a fund, you're essentially diversifying your investment. And we will hit on that concept right now. So this is the idea that not keeping all of your eggs in one basket. If you drop that basket, you're out a bunch of eggs. So it works very similarly with investments. So the negative return on some of your investments will be counterbalanced by the positive returns in other investments. And this can be achieved through investments in multiple stocks, investments in multiple different bonds, or investments between stocks and bonds. So, the poor performance in one stock will be counterbalanced by the positive performance in another stock. The poor performance in a group of stocks will be counterbalanced by the positive performance in a group of bonds. So that's the basic idea of diversification. Then the last concept I will touch on before opening it up to your guys' questions is this idea of compound interest. This is why all of this is worth it. So this is the idea that interest will earn interest over time. So I think this is best illustrated with an example. So let's say today you deposit $1,000 into an account that promises to earn 5% interest every year. So after 1 year, you've earned $50 on that initial balance. After 2 years, you earn another $50, so that interest is now at $100. But additionally, this $50 has earned 5%. So you've got $2.50 additional earnings in that account had you not been compounding that. So over a 2-year period, that doesn't look like much, but when you take this out over 40 years, you can see it's quite impactful. The account balance, no interest, simple or otherwise, you would have just had your $1,000 after 40 years. Throw simple interest on there so you don't earn interest on that that is being compounded, you're at $3,000. But when you add compound interest, so your interest is earning interest, you're up above $7,000. So really impactful in terms of investment performance. Also have some resources on investment education, assessing your risk tolerance, and investing fact sheets. So with that, I will take any questions that you guys might have.